In this video, we will see about money market. Money market. The money market refers to the trading in very short-term debt investments. At the wholesale level, it involves large volume trades between institutions and traders. At the retail level, it includes money market mutual funds bought by the individual investors and money market account opened by the bank customers. Now let me see the objectives of the money market. Providing borrowers such as individual investors, government with short-term funds at reasonable price. Lenders will also have the advantage of liquidity as the securities in the money market are short-term. It also enables lenders to turn ideal funds into effective investment. In this way, both the lenders and borrowers get benefit. RBI regulates the money market. Therefore, it turns help to regulate the level of liquidity in the economy. Since most of the organizations are short on their working capital requirements, the money market helps such organizations to have the necessary funds to meet their working capital requirements. It is an important source of finance for the government sector, both national and international trade, and provides an opportunity for the banks to park their surplus funds. Types of money market: commercial papers, treasury bills, call money, commercial bills, certificate of deposit. Commercial papers. Large corporates and banks will issue commercial papers to raise short-term funds. Individuals, banking companies, non-resident Indians and foreign institutional investors can invest in the commercial papers. Commercial papers can be issued for the maturities between minimum 15 days and maximum up to 1 year from the date of issue. Commercial papers was introduced in the years of 1990. Commercial paper is used to borrow money directly from the market. The rate of interest is lesser as compared to the banks. Only reputed organizations whose papers have good rating can borrow money through commercial papers and save money. For example, the owner of large retail store like Big Bazaar wishes to raise funds from the market to purchase its merchandise. If it were go to bank for loan, then would probably have to pay around 15% interest. But from the open market, it could perhaps get loan at only 10%. Hence, by resorting the instrument like commercial papers, the organization gains 5%. Treasury bills. Treasury bills are issued when the government needs money for a short period. These bills are issued by the central government and interest on them is determined by the market forces. Treasury bills having maximum maturity period of 364 days. These are the discontinued securities. These are issued at the discounted rate, redeemed at the face value. RBI, SEBI, commercial banks, state governments, financial institutions like LIC, UTI, IDBI, NABARD, ICICI, IFCI are the participants. Types of treasury bills. Ordinary treasury bill issued to the public and other financial institutions. These bills are freely marketable. Ad hoc, which is issued in favor of RBI only. Ad hoc treasury bill are issued for providing instrument outlets to state government, semi-government departments and foreign central banks for their temporary surpluses. It represents the cash balance of central government and can raise finance. It was abolished on 31st March 1997. This picture shows the treasury bill which is issued by our government in the years of 2022. Call money. Call money is the short-term finance used for the interbank transactions. It has the maturity period of 1 to 15 days. All the commercial banks have to maintain some minimum cash balance as per instructions of the RBI known as cash reserve ratio. This ratio changes from time to time as per their liquidity in the economy, thus affect the availability of funds for providing loans with the banks. Banks sometimes borrow money from each other for short duration to maintain their cash reserve ratio. This is known as call money market. The interest rate on such call money is known as call rate. Commercial bills. These negotiable instruments are used to fulfill the working capital requirement of the businesses. Its maturity period is usually 60 days or 90 days. It is easily transferable. The drawer of the bill can wait until the due date, the date on which the drawee will honor the bill. If he does not wish to wait, he can discount the trade bill with the bank before the maturity period is over. This makes the bill very flexible and easily marketable. Certificate of deposits. A certificate of deposits is an agreement between depositors and authorized bank or financial institution. The agreement is for specific period of time with certain amount of money to invest where the financial institution pay interest. General public, bank, corporate companies, trust, association, funds. Maturity period of the certificate of deposit is minimum 7 days and maximum 1 year. There is no risk on investment. Minimum 1 lakh rupees is required. I hope this video is very helpful for you to know about the money market. Thank you.